Hey everybody, this module here is going to cover contribution allocation setting strategies. Basically, it gives you it's to help you get an idea of how to set up your contribution allocations or the new money that's coming into your account. So you know where to actually have it, which fund or funds to have it go to based on what your preferred investment strategy is. I'm going to cover basically the four different types of investment strategies that are commonly used by members of the group. I'm not going to go over great details on them all, and there are going to be other areas here that I'm going to cover that are probably going to create more questions, and I'll get to that in a minute. But I don't want to cover all that right here. I want to keep this short and to the point, and I will cover the other stuff that might create questions in future modules. All right, so let's talk about the four investment strategies that you'll see among members of the group. First one here is the long-term buy and hold, or also known as the B&H strategy. Now, this is the most common one, and it's actually the one that I tend to recommend most everybody in the group use if you don't really know what you're dealing with. That basically involves staying long term in your whatever position you have. Doesn't matter what the economic conditions are like. If you stay focused mostly on stock funds, for example, don't worry about bear markets and recessions most of the time. There are times I will hopefully help you avoid those particular areas, but um, even if you do get caught in one of those, there you can still take advantage when those periods happen. At least as long as you're still contributing funds. Swing trade strategy is the next one I'm going to cover. That's the one that I'm more aching to use, and although I haven't been so active with it over the last few years, you will see me occasionally swing in and out, but what kind of conditions the market and economic are both giving me is going to dictate how frequently you'll see me moving my own money. There are other people who are also going to actively move their money around as well. Again, that's swing trading. That involves basically moving everything from 100% in whatever stock fund or funds to 100% G fund typically, and then moving back from G fund to 100% stocks as short term um, prices rise and fall. Okay, next strategy is the hybrid buy and hold strategy. Now, basically, that's somewhat, and if you will, a mix between the buy and hold and the swing trade strategy. So basically, what it boils down to is the existing money that's in the person's account stays in the buy and hold setup, but then the new contributions tend to go to the G fund and get moved over when by an IFT whenever the investor wants to move it over. Okay, and lastly, we'll talk about the seasonal strategy. You don't see it quite as much from members, but there are members who are active in the group who do actually use them, and I'm going to talk a little bit more about that too. But again, I want to focus this specifically on contribution allocations, basically your new money that comes into the account. What do people with each of these types of strategies typically do? Okay, so the long-term buy and hold strategy, the first option, the person will normally set their contribution allocation to match the most recent IFT. So in Deb's case, her most recent IFT or interfund transfer was to 65C35S, or for those of you who might be a little newer and not understand what I meant by that, 65% in the C fund and 35% in the F fund is where she moved her existing money from to. Now, it's not how she specifically has her own contribution set up to go, but most of the people in the group are probably going to be along the line of setting the CA to match whatever their last IFT was. Okay, so um, the next one, it would be setting the CA to go to underperforming funds. Now, this seems to be counterintuitive, or kind of defy logic, but there actually is a lot of logic to this, and it makes really good sense um, to the right kind of investor. It actually can be a very useful way to outperform the same funds you're invested in. To be honest with you, uh, this is actually the way, somewhat the what Deb's strategy is with her current contribution setting of 60C, 30S, and 10I. So, example, the 10I part, because it's, her contributions are very similar to what her actual distribution is, but she has a small amount going into the I fund, and the logic on that is if the I fund is underperforming, she's able to buy up more shares of I fund for basically a cheaper price. Um, basically, if the stronger a fund performs, the less shares you can buy of it with the same amount of money. So if you have a constant amount of, let's just say, $700 going into your TSP account every 2 weeks. Now this is assuming you're a civilian, by the way. Then, so as the share prices climb, you're gonna be able to buy less and less shares, and then if the share price drops, you're able to buy more and more shares. So whenever the price changes, or actually when the price is dropping, you're able to buy more and more shares. You're actually using dollar cost averaging, which is something you can take advantage of. Now, talking about that here, basically you can end up buying more shares at the lower price, and it ends up bringing down your average cost of all shares that you hold to a lower level, and it makes it easier for you to turn a profit. In fact, you can turn profit before the price even reaches an original high, whatever your original high entry point was. Again, I'm going to go into that in more detail in a different video, though. All right, next one. Intent may also be based on cyclical nature of stock prices. Now, what I mean by this is a lot of times investors, when there's a dip that happens and they're ready to start buying back in because they're starting to see value or whatever, or something triggers them, they might focus their attention in a group on a specific group of stocks. So a good example might be they focus on the large cap companies first, or the ones that are in the C fund, and then so that might perform the strongest over a shorter period of time, and then maybe the S and I fund are both going up, but not quite as strongly, even though they very well deserve to go up just as strongly, if not stronger than C fund at the time. So so they might fixate on the C fund first, and then once the C fund's value gets saturated to the point where they're not expecting to get so much performance out of it, or not any, before and it tops out, they might decide to move their money from the C fund, some of the companies that are in the C fund, to companies that are in the S fund, and make the S fund go up faster, and then the C fund will underperform later. So that's what I mean by cyclical nature. It's sometimes taking advantage of the fact that investors do tend to have these habits. All right, and again, I don't want to cover too much great detail on this. I just want to give you guys options or ideas on where to put your contributions. All right, swing trading strategy. The first setup is to always set your contributions to go to 100% in the G fund. This allows you to somewhat control the price that your new contributions enter the stock fund positions at. Okay, and the rationale on this is, why would you buy shares at a higher price if there's a likelihood the same money can be spent on cheaper shares in the near future? Because stock prices usually do have a very up and down nature to them with their prices. They do tend to go upward all the time long term, but within the long term, now you might have what you call a wave, and then a ripple. Basically, there's like three types of waves. Basically, you'll have the bigger wave, then you might have like a wake or something, and then a ripple. Okay, so swing traders tend to try to take advantage of the little ripples and smaller waves in there, and basically jump out of the stock funds when they're at short-term highs, and then buy back in on short-term lows. Now, because of that, because they're with the fact that the prices tend to fluctuate enough where the the individual is not likely going to stay in any particular fund for too long, just it's not really much to worry about with where the new contributions go, because it's what money is going into there usually is not going to stay there very long before it gets IFT'd back into the stock funds anyway. Also, this is the amount of money that's in your contributions is of much greater insignificant, or it's much more insignificant in value relative to your existing balance. The greater your existing balance is, and the smaller your contributions are. So, in other words, let's just say someone is putting in the max $19,000 a year or something like that, and they're getting the max, the agency match also, and we'll just give it a round figure of $1,000 per, for every 2 weeks that the money goes into the account. $1,000 is a much more significant value amount of the person's account balance when they only have $10,000 in the account than it is if the person has $100,000 or even $500,000 in the account. Now, someone with a $500,000 account and putting $1,000 in a week, that's only 0.2% that is of the account balance or account's value that is getting added to the account every 2 weeks. So it's very insignificant. But for those of you like maybe are just starting out and have smaller balances, maybe the $10,000, now $1,000 out of $10,000 is 10%. So it's a more significant amount when you're just starting out. But as I mentioned, though, the greater your account balance is and the smaller your contributions are, the less of a concern it is where your contributions actually go as a swing trader. And again, the money's not going to stay there very long. A typical swing trader might swing in and out within about a 2-month cycle at most, normally. You haven't seen anything like that from me lately over the last few years, if you have been in the group a while, but I will actually swing trade anytime I see an opportunity that I'm reasonably sure I can take advantage of. Now, the reason why I'm doing this is, I don't move out of stock funds unless I know I can buy them back for less. So, example, if I want to sell out at $50 a share, or whatever, and maybe it's $100,000 balance, then it's the equivalent of having like 2,000 shares that I'm selling off. And then if the price just drops even $1 to $49, that's only a 2% drop, but what I get out of that is I buy back 2,040 shares, not just the 2,000 I originally sold. So when the price goes back up to $50 a share, that extra dollar, and with the extra 40 shares in my hand, now that's an extra $40 in my account that wasn't there previously. So it's not necessarily a huge difference with each single swing, but the more I continue to make effective swing moves like this, where I buy back more shares than I sold, the more I can increasingly take advantage of it over the long term. Now that's the idea behind that. Again, I'm not going to dwell on this stuff and go over all the pros and cons of every strategy, because they all have their own. We're just talking about contribution allocations again here. So moving on now, option 2 for the swing traders would be to set your contributions to go to the same stock fund that your existing money is in if the short-term prices are believed to be low. Basically, you're buying into stocks when stock prices are low, and then as stock prices get on the higher end of the short-term cycle, set it to 100G when the short-term prices are believed to be high. Now, for a lot of you who don't know how to figure this out, the announcement post is the best place to look. I have information on there. I have a S&P 500 or C fund price targets in there. All you have to do is look at what level the S&P 500 is currently trading at and compare it to the numbers you see in there. I have that section broken down into 2 sides. I have a buy and hold section and a swing trade section. If you're a swing trader, look in the swing trade section and see how the S&P 500's price compares to those. If it's in the high end of that range I'm looking for, then that's the time where I would normally be swinging out to G Fund with my own money. And then as the price drops preferably into that normal support range that you'll see in that post. That's when I'd like to buy back in, although I will buy back in sooner if I have reason to doubt that the share prices will actually drop down to my normal range. Uh, there are a lot of different conditions that exist, though, so I am very adaptive to what I'm seeing going on there. I don't force myself into waiting for this or that to occur when it's not necessarily going to happen. All right, so moving on though, the hybrid buy and hold strategy is, like I'd mentioned, I think earlier. It's basically a hybrid between a buy and hold investor and a swing trader. Now, a hybrid buy and hold investor keeps their existing money right where it already is. So if you're following Deb, 65C, 35S, and you'd stay that way. However, your money, your new money would go to 100% in the G fund. Yeah, anytime you make contributions, and then whenever you see these short-term dips come, the hybrid buy and holder will actually do an IFT to what I call reset to their previous position. So, if you're at 65C, 35S, you make some contributions over a course of a couple months, whatever, and then you see a dip come, you stay in the 65, 35 with your existing pot, but when the prices fall, you take advantage of that by moving the money that your new contributions that went to 100G into that same 65C 35S position by doing another interfund transfer to reset your position back to 65C 35S. Now, even though you might have done a previous IFT to 65C 35S, it doesn't mean it's going to stay that way. In fact, I guarantee it won't. It just takes a single day of share price changes that are not proportional to what your distribution is for that to change to something fractionally off. So you might have 65 in the C fund at first, but then the very first day the share price changes, that might maybe the S fund outperformed it, and it might drop to 64.9% or something. And then another day the S fund might outperform again, and then your C fund will your distribution will actually change to maybe 64.8 and 35.2. So you get the little incremental changes there based on based on which shares are performing better than others at any particular point in time relative to when you last reset it. But and so that's what I mean by resetting, is just when you get those little fluctuations there, little deviations, and then you're ready to move the new contributions into your stock fund position, and you basically just reset your position back to where it was. And then when you do that, your G fund shares that you're buying into move into the CNS. All right, so the last one I'm going to talk about is a seasonal strategy. Not a heck of a lot of members of the group use this strategy. There is another group on Facebook. I'm not in it myself. I want to say it's called TSP Seasonal Strategies. Deb is also in it, and there are some other members in the group who are in it. This basically involves moving money from basically 100% in one fund to 100% in another fund, based on historical tendencies over any particular specific time period. It might be over a course of a calendar month, like from the first to the first day of the month to the last day of the month, or it could be any other thing. It could be something that maybe someone figures out that between the 5th day of January and the 8th day of February, a certain fund tends to be the best performer, and then from 8 June to maybe 10 March, another fund might tend to be the best performer, and then from 10 March to, we'll just say, 6 April or something, yet another fund might be the best performer, or vice versa. So what will happen is these seasonal strategy traders will put 100% of their money in whichever single fund historically has the best performance in that particular block of time that they're working with. Now, what do these people do? They normally, as far as I know, they tend to put all of their contributions into whatever the same fund is that their existing balance is in. So anytime they do an interfund transfer from one fund to another, they're probably going to change their contribution to do the same thing. So that's all I have on this. There are some other other details in here. I know you're going to wonder about it. I know this video is raising some questions for those of you who are brand new to the group, like what are the pros and cons of each of these strategies. Tell me more about the dollar cost averaging. How does that work and all that? I will get into that when I'm building up these modules, but I will post them sometime in the not so distant future here. Okay. I just want you to know, if you just figure out what strategy seems like the most ideal fit for your own personal lifestyle needs, and then go with it. And hopefully this will give you some ideas on what to do with your contributions. All right, that's all I have. And please ask any questions, or let me know what you have any comments, whatever. Thanks.